Welcome back to this video series about private equity net returns, where we talk about how equity return multipliers are the fastest way to calculate net multiples and net IRRs that address the SEC's new marketing rules going into effect November 2022. My name's Mike Reinert. I've worked in the industry for 15 years. I run the AUXILIA Mathematica website, and I wrote the book Private Equity Value Creation Analysis. These videos cover findings from my work, website, and book, and they're designed for private equity practitioners who raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download the Excel files behind every episode. This is the third video in the Private Equity Net Returns series where I show you a better way to calculate net returns for groups of private equity deals that don't have real net returns because they're not real private equity funds. Let's go back to the portfolio in the last video. What we have here are the gross returns, representing the dollars flowing back and forth between the fund and its portfolio companies. According to the old marketing rules, we always had to show a net return for the portfolio, as demonstrated here. With these new marketing rules, some would say that we should also show hypothetical net returns for the realized and unrealized deals as follows, and some would go so far to say that every deal on this table should also have a net return. Now, as we saw in the last video, traditional, conventional net return models don't do this well because they require arbitrary decisions about hypothetical management fee, fund expense, and carried interest deductions. However, if we can make those deductions systematic rather than arbitrary, we can make our models scale. I showed how this can be done in Chapter 14 of my book, Private Equity Value Creation Analysis, and we'll run through the math again quickly here. We start with the net multiple of invested capital, which can also be called the net multiple, net MOIC, or total value to paid-in capital. Let's define this as the net return, NR, which is the sum of LP distributions and fair market value, divided by net invested capital, NIC, which are the LP contributions. Now, in any of these oversimplified hypothetical net return models, we consider the net return to be the gross return minus carried interest, and we consider net invested capital to be gross invested capital plus management fees and fund expenses. It's relatively easy to calculate F&E and carry for a fund. The problem is that when you split up a fund into groups of deals, or you combine deals from different funds, figuring out how much and when F&E and carry should be allocated to each deal becomes an arbitrary decision that has a big impact on your final numbers. The better net return model fixes this because it replaces arbitrary addition and subtraction adjustments with systematic multiplication and division adjustments. Let's see how it works. Let us start with the fund's fees and expenses. The F&E number is something that you can usually find on an LP's capital account statement or a fund's quarterly report. We will define %F as F&E divided by gross invested capital. So it puts fees and expenses into relative terms and allows us to rewrite the denominator as gross invested capital times a quantity 1 plus %F. Now, this 1 plus %F quantity is actually the equity return multiplier for management fees and fund expenses, and we'll get back to that in a minute. First, let us deal with carry. This is a conditional function. If the gross return minus gross invested capital minus fees and expenses is less than or equal to 0, carry is 0. If not, carry is equal to a share of these net profits. That share is usually 20%, but we'll use the variable %C for it here. That'll allow us to change the number if we wish. If we plug carry into the formula above, the numerator will look like this. The max function there, that's what gives us conditionality. It makes sure that there's no carry if a deal does not return more than gross invested capital and fees and expenses. Technically, it's a bit more complicated than this. There's usually an 8% hurdle rate that needs to be achieved before a GP earns carry, and then a catch-up period with an 80-20 waterfall. We're going to ignore that here because doing so gives us a more conservative result. And nobody should complain if the GP actually returns more money than they claim in their marketing materials. Now, with a bit of algebra, we can rearrange the numerator so that the net multiple formula looks like this. And you're probably wondering, why would we ever do such a thing? Because this carried interest expression is definitely more complicated than it was before. Well, we go through all this because it allows us to express the impact of fees and expenses and carry as multipliers, where the net return is the gross return divided by the carry multiplier, and net invested capital is gross invested capital multiplied by the F&E multiplier. And this means that the net multiple is equal to the gross multiple divided by the two multipliers. Okay, that's pretty theoretical. Let's see how it works with an example. The fee and expense multiplier is 1 plus %F, which is 1 plus fees and expenses divided by gross invested capital. In the previous example, this would be 25 million divided by 180 million, so the F&E multiplier is 1.139x. The carried interest multiplier has this form. Despite its apparent ugliness, the equation only requires three numbers: %F, the F&E multiplier, and the gross multiple of invested capital. When we plug these into the formula, we get a carry multiplier of 1.073x. Now to calculate the net multiple, we divide the gross multiple by these numbers. This gives us a net multiple of 1.410x. Now, you may be thinking, wow, that certainly does not look like an easier way to calculate a net multiple, but as you will see in a minute, this method scales. Here's a table of portfolio gross returns that we showed earlier. Now let's add columns to it for the fee and expense multiplier, carried interest multiplier, and net returns. The line at the bottom shows how we calculated the net multiple for the portfolio. We just divided the gross multiple by the two multipliers. What makes this model scale is that we can apply the same multipliers to every deal in every group of deals on this table. And in each row, we can calculate a net multiple just like we did for the whole portfolio. This works because in a real fund, management fees, fund expenses, and carried interest are all pooled. Using the same multipliers like this makes sure that we're treating all the deals in exactly the same way. Each investment gets automatically adjusted for its pro rata share of fees and expenses based on gross invested capital in the second column, and each investment gets automatically adjusted for its pro rata share of carried interest based on total value in the fifth column. Now, this is how it works in a pooled carried interest model, but we can also calculate carry on a deal-by-deal basis. To do this, we simply let each row have its own carry multiplier that's calculated from its own gross multiple and the F&E multiplier. This will give us slightly different returns. Deals with positive returns will be a bit less positive. Their carry multipliers are higher because they're not offset by underperforming deals. We also see that deals with negative returns are a bit less negative. Their carry multipliers are 1.0x. This means that there's no carry deduction because the deals have not returned more than gross invested capital and fees and expenses. Both of these models are valid. It's really just up to the analyst to pick which one they want to go with. Now it's worth pointing out the ranges on our multipliers. The F&E multiplier ranges from 1.0x to about 1.25x. This is because %F is fees and expenses over gross invested capital. The lower bound is 1.0x because F&E should never be negative. And we really shouldn't see a much higher than 1.25x. That would mean for every dollar of invested capital, the GP is charging a quarter of management fees and expenses. That's a bit high, even for private equity. The carry multiplier ranges from 1x to 1 over 1 minus %C. These are both mathematical limits. The lower bound of 1.0x means there's no such thing as negative carry, and the upper bound is a mathematical limit of the gross multiple going to infinity. It says that the carry multiplier for a fund with 20% carry would max out at 1.25x, and the multiplier for a fund with 10% carry would max out at 1.11x. In practice, you'll rarely see a deal that gets near the max. That's reserved for gross multiples of 20x or higher. In the table above, we see carry multipliers getting up to around 1.14x for a 3x deal. So this works really well. It provides easy and flexible ways of calculating net multiples, but we're still missing the net IRRs. For that, we need to turn back to the gross cash flow spreadsheet. Remember how we said that we calculate a net multiple by making gross invested capital bigger to account for management fees and fund expenses, and by making gross returns smaller to account for carried interest? Well, we can do the same thing here with each of the individual cash flows. Let's first add our F&E and carry multipliers to the table as follows. Now, whenever we see a negative number, let's make it a bit more negative by multiplying by the fee and expense multiplier like this. This adds to each deal its pro rata share of management fees and fund expenses. Then, whenever we see a positive number, let's make it a bit less positive by dividing by the carry multiplier like this. This subtracts from each deal its pro rata share of the portfolio's carried interest. What we're left with is a set of hypothetical net cash flows fully adjusted for management fees, fund expenses, and carry. Not only do we get a net multiple and a net IRR for the portfolio, we get net returns for each deal and net returns for the exited and active subtotals. So that's 22 different net return measurements all on a single spreadsheet. Now this here is a pooled carry model. What that means is we calculated the F&E and carry multipliers for the entire portfolio and then kind of worked backwards, applying those multipliers to each of the deals. But that's not the only way we can do it. We can also calculate the carry multipliers for each deal independently like this. When we apply them to the company cash flows, we get a deal-by-deal carry model and a set of deal-by-deal net returns that are usually a bit more conservative than those of the pooled carry model that we showed earlier. In this model, the totals and subtotals over on the right also have carry multipliers. You just can't see them until you add up all the individual deal-by-deal net cash flows. Now, I know I went through these models quickly, so go to the website and download the Excel file for this episode. On it, I have a tab for both the pooled carry model and the deal-by-deal carry model, so you can play with the parameters and see how they change the returns and use it as a template to build your own net cash flow models. Okay, with that, we can go back to our performance table and plug in the net multiples and net IRRs needed to make our compliance people happy. Here we'll use the numbers from the pooled carry model. Now, one of the benefits of this approach is that all the net returns on this table are mathematically consistent. Remember in the last video we said that to create 11 different net IRRs like this, we needed to build 11 separate models and write 11 paragraphs of footnotes to explain the amount and timing of every management fee, fund expense, and carry deduction. Those 11 models were not mathematically consistent because each required different arbitrary adjustments to make the cash flows look more like traditional fund cash flows. That's not the case here because we're using the same assumptions and the same math for every company in the portfolio. And that's going to be a lot easier to explain to limited partners, lawyers, and regulators. Here's how I would write the footnote that explains the pooled carried interest model behind these numbers on the table. I won't read it, but it basically says three things. 1. We start with the portfolio's actual gross cash flows. 2. We increase every inflow by its pro rata share of $25 million in management fees and fund expenses. And 3, we decrease every outflow by its pro rata share of the portfolio's carried interest, which is calculated as 20% of net profits. That's it. It fully explains every number on this table. If you have the gross cash flows and the $25 million fee and expense number, you have everything necessary to recreate this model. So this is pretty good. We went from spending a whole weekend building and maintaining hypothetical net return spreadsheets to this, which can be updated in a few hours. But would you believe me if I told you there is an even faster way? Meet Cyber Stacy, a private equity associate from the distant future. She figured out how to build extremely accurate net return models that don't even require cash flow spreadsheets. With this approach, you can calculate very good estimates of net IRRs by clicking a few buttons on a handheld calculator. We'll show you how to do that in the next video. Don't forget to check out the link to the episode page in the description where you can review notes and references and download the Excel models that we discussed in this video. If you need more help getting up to speed on your net return models, feel free to get in touch. Thanks for watching and see you next time.